20%, then you'd have 1.2 million the next year, right? And then you could do it again. You could do it ad infinitum, right, at that level. So you just have to be able to stomach the volatility. The way you stomach the volatility is you keep your loan to value really low, really low. Even smarter idea though is if you're a dentist or you have some kind of business, finance your cash flows. Like you have a business, right? If you can sell equity in the business, that's a way of financing the business. And if you mortgage the business, that's a way of financing the business. And both of those have the benefit of not being marked to market loans. Well, let's take the extreme. What if I offered you $1 million loan for 100 years on against your personal signature, and the interest rate was 3%? Would you feel it's risky to buy Bitcoin with that? Like, what's the worst that could happen?
Not much.
Nothing, right? You'll be dead in 100 years. The worst that could happen is in 100 years, after you're dead, the Bitcoin is worth less than $1 million, right? Small chance. Maybe you can come up with some way. Bitcoin goes to zero the day after you take the loan, and you can't pay the 3% interest. Then I guess it comes due. So slight risk of owning the Bitcoin, but you see, as the term of the loan extends, as the interest rate falls, and as the collateral changes, debt goes from being debt to being equity. What if I just gave you the $1 million forever and no interest rate and no redemption rate? That's equity, right?
Yeah.
Would you take that and buy Bitcoin with it?
Probably.
Why wouldn't you?
Yeah.
Like if you're a dentist and your dental practice is going to appreciate it's going to grow 5% a year. You're going to grow your top line 5%, your cash flow is 5%. And someone said they want to invest in your dental practice and buy half of it and they'll give you $1 million. Would you give them half of your upside and then take the $1 million and invest it in Bitcoin, which you thought was going to grow at 20% a year for the next 20 years? You see, in that particular case, what you're doing is you're diversifying your portfolio from a cash-rich value stock, right, your cash practice, to now a property portfolio. So I think when you're really thinking about financing, the question is, what kind of money can you raise and what strings come attached to it? And it's different for everybody, right? It depends on what country you live in. If you live in the US, you have Fannie Mae and Freddie Mac, and you need a car, you can pay for the car in cash, or you can borrow money at 2% interest to buy the car. Well, everything is a choice of, do I own Bitcoin or not, right? If I pay for the car in cash, it's like I pay for it in Bitcoin, right? It may be worse. It may be like, if I pay for the car with Bitcoin, not only did I pay for the car, but I paid for it twice because I got to pay tax on the Bitcoin if I own the Bitcoin. So the worst case would be to give up $100,000 in Bitcoin to get a $50,000 car. The next worst case would be I had $50,000 in cash. I could either buy Bitcoin with it or I could buy a car with it. And the best case would be I bought the car for nothing, and I accepted a 3% loan against the car that I pay off over 7 years, and I kept the Bitcoin. So I bought Bitcoin. So ask me a question: would I rather borrow money at 3%? Sometimes, by the way, you can borrow money at like 0% interest to buy a car. Have you noticed? Like, if the dealer has a subsidy, sometimes the dealer will subsidize the loan, and they'll give you a no-interest loan or a 1% loan to buy the car. So, Mike, should I borrow money to buy the car, or should I pay for it in Bitcoin and not invest Bitcoin? The answer is, I think I would take the loan. I would take all the credit you would give me, and I would maximize the portfolio. I think the general principle, if you step back, is in an inflationary environment, right? If the inflation rate's 15%, the monetary inflation rate is 15%. If the inflation rate is 15% and the cost of capital is 5%, and you have a use of proceeds, if you've got a property that you believe will appreciate faster than 15%, let's say 30%, right? Then all day long, what you would do is you would take on debt and pay the 5%. You would invest the capital into the property yielding 30%. You would scrape the 25% arbitrage. And the only thing you would spend your time focused on is, how do I negotiate the terms of the loan so I don't get forced liquidated by a capricious lender? Like, I don't want, for example, if you could buy a house and the house was a 3% mortgage, and you could either pay for it in cash or pay 3% mortgage in an inflationary environment, you would probably take the mortgage, right? Probably. Now, what if the bank had a clause in the loan that said, every month we can send an appraiser to your house, and if we think that your house is worth less because it got struck by lightning, or your neighbors moved in and they blare loud music, or because the mayor instituted lockdowns in your city, if we think it's worth less, we can mark down the price of the house by 25%, and then if it gets marked down below the value of your loan, then we can call the loan and you owe us the principal immediately on demand. Now, would you take the loan?
No.
Yeah. So the problem is the terms, not the loan.
That's why basically borrowing on exchanges is the worst thing you could do.
Because the exchange could mark down the value of your collateral while you're asleep, based upon a manipulation, and force liquidate you and take your life savings.
Yeah.
It's like you went to bed and Bitcoin was 49,000, and during the night it traded down to 16,000 for 13 seconds. And then the exchange force liquidated you, and they took all your money and sold your Bitcoin at 23,000, and you've lost everything. And now Bitcoin is trading at 59,000 again. And how do you feel? You got
it's happened.
Abused, right?
Yeah.
Okay, so that's the problem with mark-to-market, especially mark-to-market when you post your collateral in the hands of a counterparty. And that could even be some like Dogecoin guy manipulated the market down. Like that. The real problem in the crypto world is it could be yo-yo coin levered up 100 to 1, force liquidated, rippling into ETH, rippling into Bitcoin. In fact, I'm certain that volatility from all these other cryptos does ripple into Bitcoin. You can watch it. Right? It's like someone hammers this thing 37% and the ripple is felt over here because Bitcoin is cross-collateralized or pledged as collateral to ETH, which is pledged as collateral to yo-yo coin or something, and these things are all highly levered and traded all the time. So I think you got to be really careful, like in general, about pledging collateral that could be forced liquidated. But I think that if you can actually raise debt with fixed collateral, right? The best thing is I mortgage a property, I mortgage a building, I mortgage a car, I mortgage a business, I borrow money on a personal non-recourse loan, something like that. And then I use that because you want long-term capital that's got a low interest rate. But even at the end of the day, the interest rate is really secondary. Like whether you pay 4% or 8%, at the end of the day, isn't really as important as whether or not the collateral is marked to market and forced liquidated on volatility. Right? That's really the material thing that'll destroy you. Right? The likelihood that Bitcoin will trade down 50%. For 1 minute sometime in the next 5 years is high. But the likelihood that it will trade down 50% and stay there forever is low, right? So you just got to understand that.
Yeah.
But now, by the way, I think one more point to make, which is important, is the monetary inflation rate is the risk of doing nothing. So if the monetary inflation rate was 7% monetary inflation every year, and you were thinking about investing in something, right? You would think, well, there's only a 7% cost to do nothing. But if the monetary inflation rate went to 21%, now the cost is 21. You have to believe you're going to get wiped out 21% of the time not to do something. And if the monetary inflation rate went to 60%, then you would have to believe there's a 60% chance of losing all your money in the next 12 months to do nothing. So as the monetary inflation rate, let's take Lebanon, right? In Lebanon, if the currency lost 90% of its value in 12 months, and I gave you any other option, as long as the other option doesn't liquidate you, it doesn't wipe you out with 90% probability, you would have been better off to take the other option. So I think that the decision making here, your thought about taking on leverage becomes easier as the economy hyperinflates. Let's take the extreme. I tell you that the local currency is going to lose 95% of its value in the next 12 months. Wouldn't you think you really just want to mortgage up just about everything, because that's like 2% a week almost. So, yeah, I mean, certainly if you could get credit card debt or whatever, the local currency return on digital property is going to be 180, 200, 300% a year. Like what does the number look like in Turkish lira or Argentine pesos right now for Bitcoin over the last 12 months? It's probably pretty ridiculous, right?
Yeah. Yeah, absolutely. Well, what are your thoughts on inflation moving forward? Where do you see it going? Do you see us sticking around the 15-20% range for the next few years, or going higher or lower? Or do you just not know much about the future and prefer not to speculate? That's a perfectly acceptable answer, by the way.
On inflation, couple of points. One thing I said today on Twitter is that there's 4 big myths. The first myth is it's CPI. The second big myth is that it's even a single number. The third big myth is it's caused only by monetary policy. And the fourth big myth is that it can be cured by manipulating the interest rate. And I think that people have misconceptions about all those things on inflation. It's caused by unhealthy policies of government, by the government meddling in the economy in an unhealthy fashion. That's what causes inflation, in the same way that inflammation is caused by unhealthy chronic practices in your personal life, right? And if you continue them, the inflammation continues. And if you continue with the government engagement with the economy, the inflation will continue. And you can't just stop it by raising interest rates to 15%. Right? If we jacked all the interest rates through the roof tomorrow, as long as there are tariffs and there are labor controls and there are manufacturing controls and there are travel controls and there are other government edicts and medical interventions, those things, even without money printing, if the money supply didn't expand at all, you still have inflation, right? If you do the simple thought test, if the money supply is constant, and I pretty much made it illegal for anybody to work except on Tuesday and Thursday, the price of everything goes up, right? If I say that you have to have a seat in between you and the next person on an airplane, the price of the ticket doubles. There are also every single ingredient drives inflation, and we have more of them than in our lives, right? Never in our lives have we seen so much government engagement with the economy, and that's what's called the inflation rate. If I wanted, so with that as a caveat, right? Since there's no one number, the closest thing we can get to one number is a single number for the rate of monetary inflation, the cost of capital, if we simply liquidated all the capital in the civilization and we reduced it to dollars and we said at what rate are we inflating that index? And I guess I'm persuaded it was 7% for a decade in the U.S. and Western Europe from 2010 to 2020. I think, this is interesting. If I look at the S&P index, it was about 10% for that time period. It's 13% right now, but we include this massive 2020 before COVID, about 10%. And I got to figure 7% was monetary inflation, 3% was some kind of productivity or something. That's my best guess. And if I look at it right now, in the past 12 months, we've got 23%, 24, almost 24% on the S&P index. And that means at least 20%, 21% monetary inflation. That doesn't account for the dilution from issuing excessive debt and equities in the S&P 500. So if you allowed for that, then you could make an argument that we've got monetary inflation equal to the S&P or slightly, but we're looking at monetary inflation in the Western world tripling. And if I look forward the next 4 years, there's no circumstance under which you wouldn't consider it's got to go at double the rate it was from 2010 to 2020. So it's minimally 15% a year, I figure, and then logic says between 14 and 22% is the best guess. And I would allow for a little bit of flexibility there. Like I would swear no chance it's going below 14%. No chance. But if you're a pessimist, you would say 22, 23%. And if you're an optimist, you'd say 14%. And then you would say that for 4 years, and then maybe we'll get some taper 2024 between 2028, and maybe we can taper from 14 to 12 to 11 to 10. But at the end of the decade, can we get back to inflating at 7%? Right, maybe that would be success, right? And the catalyst for that would be digital transformation of the economy. Maybe digital, the growth of digital property, Bitcoin, the digital transformation of everything else, of assets, the digital transformation of products. A massive, we're distorting the economy so much, though, that we're really changing the definition of GDP. And maybe even for example, if no one goes to a movie theater ever again, and if we eliminate 90% of business travel, then both of those are deflationary. And we could say we have more business meetings and we watch more movies, but the economy will contract. So I think that will start to come into play. It's like, that's like a hedonic adjustment in a way. Like, it's not that different than your sirloin steak became soy burger or like meat derivative product, something. But it's been so long that we forgot that we ever had the other thing, so we don't know to miss it. I think we'll see some of that when you get out more than a decade. That's what makes this really difficult. But I think you want to plug in over 14%. Now, I think that the wild card here is that's in the United States and Western Europe. But I really think that what we're seeing is the system cracking on the fringe in Turkey, in Argentina, in all South America. The interest rates in Brazil are what, right? 9% right now? And the interest rates in Turkey have been 16, 15. So I think that in the developing world, you're going to see something different, right? If the U.S. inflates at 14%, what people haven't really factored in is that everywhere else they're inflating 20% to 30%. And the question is, what are the consequences? And I think there are two really big trends, right? Which is people are going to snap up digital currency if it's available. as much as they can get their hands on. And they're going to snap up digital assets, a la Bitcoin. And no, it won't be like everybody, because to your point, there's so much stubbornness, there's so much inertia, right? You're really telling me that people are believing in the Lebanese local currency even today?
Yeah. It was stunning. Like one of these blogs that I follow, which generally has semi-decent analysis on economics, so they're anti-price controls and stuff. They were saying the Lebanese lira is the most undervalued currency in the world, and it should be at 12,000. And I've heard from many friends that a lot of people had sold their dollars at certain points. At 3,000 they thought I was going to go back to 2. At 15,000 they thought I was going to get back to 10. And at 25 now they think it's going to go back to 12. And they continue with it.
Well, you can call this a currency war, right? This is like a war. So let's come back to war. There's conscientious objectors to wars. What happens if you're against a certain war? Vietnam War, World War I, tar and feather comes from what we did to people that were conscientious objectors in the Revolutionary War. So I think when things get to be wars, patriotism kicks in, and you end up with the leader of the country saying it's your patriotic duty to buy the bonds and to own the currency and to sell your foreign currency, right? So I think we'll get some of that. But wars also have winners and losers too, Safe, right? So at the beginning of World War I, everybody was on their side, and they had a lot of conviction. But at the end of the day, the war did end, and there was a winner, and there were losers. I mean, everybody struggled, but I think that here, what we see is this this conflict. But I think it's important. It's important if you want to be effective. If you want to be effective and
Yeah, let's get it, let's get it. Oh. Easy. Easy.